FANG stocks, what they are and why you should invest in them. In the world of share trading, there are some companies that everyone gravitates to when trying to determine how well tech stocks are doing collectively. These are known as the FANG stocks. These are companies that have proven to be some of the largest and most profitable stocks over the past decade or so. FANG stocks are a subset of the Nasdaq Composite. These stocks were once considered high-growth tech companies, which included Facebook, Amazon, Apple Inc., Netflix, and Google's Alphabet. FANG stock prices have been on a steady rise since November 2016 and continue to grow. But what exactly are FANG stocks and why should investors pay attention to them? And are they worth investing in today? In this episode, we'll answer all of these questions and dive deeper even more. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos about the best FANG stocks to include in your investment portfolio. What are FANG stocks? FANG is an acronym used to describe some of the most prominent companies in the tech sector. Originally, the acronym was FANG for Facebook, Nasdaq FB, Amazon, Nasdaq AMZN, Netflix, Nasdaq NFLX, and Alphabet, Nasdaq GOOG, Nasdaq GOOGL, formerly Google. In 2017, investors started including Apple, Nasdaq AAPL in the group, turning the acronym into FANG. Over the past decade, the FANG stocks have grown faster than the overall S&P 500 or the more technology-focused Nasdaq. The original 4 FANG stocks were all internet-based companies, but the later inclusion of Apple, primarily a consumer hardware manufacturer, made FANG a broader group of technology stocks. The acronym breaks down as follows. Facebook owns 2 of the most engaging and largest social media apps in the world, its namesake Facebook and Instagram, as well as 2 of the biggest messaging apps, WhatsApp and Messenger. It makes money by displaying ads to users while they browse through feeds of photos and videos. Amazon is the largest business-to-consumer e-commerce company in the world. Its Prime membership program has more than 200 million global subscribers who have proven extremely loyal to the company's online marketplace. While e-commerce accounts for the bulk of its revenue, Amazon has found profit engines in cloud computing services and advertising. Apple is one of the biggest smartphone manufacturers in the world. Device sales account for most of Apple's revenue, but in recent years the company has also focused on higher margin subscription services, including streaming music and video, gaming, news, and cloud storage. Netflix is one of the first internet-born media companies. In 2007, it started to shift from a DVD by mail service to on-demand streaming, and in 2012, it started investing in its own original content for the streaming service. Today, Netflix is one of the biggest buyers of film and television productions in the world, serving more than 200 million global subscribers. Alphabet is a tech conglomerate primarily split between Google and its other bet segment. While Google started as an internet search company, it's continued to acquire and develop consumer-facing products, 9 of which boast more than 1 billion users each. Google also encompasses a growing cloud computing business and a relatively small hardware business. The other bet segment includes Alphabet's moonshots such as automated vehicle business Waymo and health researcher Verily. Why are investors so excited about FANG stocks? The FANG gang is viewed by many as modern-day blue-chip stocks, not just tech companies. Facebook, Amazon, Apple, Netflix, and Google are firms that retail investors know and interact with in their daily lives. FANG stocks have done well over the last several years, often beating the standard indexes. They also led the stock market's rebound during the COVID-19 pandemic in 2020. While historical growth isn't a clear predictor of future growth, it does appear these tech stocks will continue to have a broad influence over the market in general, given their substantial presence in the S&P 500. However, these stocks are expensive, trading for more than $100, sometimes even $1,000 per share. An alternative option for investors is to find the next high-growth, market-moving stocks. Given the influence of tech across industries and the recent string of IPOs, maybe there will be a new acronym in the near future. Now you know what FANG stocks are and why they're so popular, let's take a look at the pros and cons in investing in them. Pros of investing in FANG stocks. Tech stocks are a great way to generate profit if your target is a short-term investment. The below-mentioned advantages can help you invest in FANG stocks. 1. Idea generates money. Technology solely depends on concepts, thus the opportunity for technologies to dominate the world is always imperative. Think of Amazon. Amazon started only as a platform for online book selling. Where are they now? Today, they reign in all possible sectors. Just like Amazon, tech stocks have a substantial possibility of returning a handsome profit. Unlike other stores available on the market, tech IPO will always have a demand. The world is becoming digitized fast, so technologies will always be a good investment. You can hold up money for the long haul because of the tech market's slightly volatile nature. That's why investing in tech stocks is a safe play. 2. Rapid growth with substantial profit. Tech IPOs have rapid growth. Unlike other stocks, it generates handsome revenue within a short period. Because the lifestyle of people worldwide has become more digitized, technology is always going to play a vital role in it. So, if you want to invest in a stock that will give you a handsome return in no time, tech stocks are the go-to option for you. 3. Existence stability. Because of high demand, advancement in technologies is proceeding at a quick pace. Look around you. What do you see? From rising in the morning to going to bed at night, you're always on your phone. You're using tech every day. As for some people, the demand is only growing. As tech products will always be in the center, so why not have a piece of the pie while you have the opportunity? If you can carefully analyze which tech IPO to invest in, generating revenue will only be child's play. Cons of investing in FANG stocks. The stock market is unpredictable in a lot of ways. Tech stocks being volatile also increases a chance for loss. The following cons can help you make the right decision. 1. Difficult to understand. Tech IPOs can be difficult to understand sometimes. One quick tip for you is if you do not know enough about a product, avoid investing in it. Before falling for the fancy advertisements of various tech products, ask yourself some questions. How popular is this tech? Would you use it? How is their position in the business? Who are their competitors? Is their management trustworthy? It is of the utmost necessity to research the stocks before making any investment. But getting answers to all these questions is the hard part. 2. FANG stocks are volatile. When market and economic conditions are positive, consumers are willing to spend more money on the latest and greatest technology, leading these stocks on a tier upward. However, any negative shift in economic data could be a signal that tech spending will decline, which will lead to declines in the values of these stocks. 3. They're too expensive. FANG stocks are relatively too expensive for the average investor to afford. If valuations continue to grow, they may become too expensive to continue to be appealing to the investing community, which could lead to a sell-off. Are FANG companies a good investment? FANG stocks have historically outperformed the S&P 500 index. As of July 2021, the worst performing FANG stock, Alphabet, has returned more than double the index average since the market bottom in March 2009. Meanwhile, Netflix stock is up more than 100-fold and Amazon and Apple shares are up more than 50 times. The 5 companies combined account for approximately 17% of the S&P 500 and about 1/3 of the Nasdaq 100 index. As every investor should know, past results don't guarantee future success. That said, FANG companies exhibit several competitive advantages that make them appealing long-term investments. Most of the FANG companies benefit from the network effect. Facebook's products are valuable to new users because of its billions of other active users. Google products, including YouTube and Search, benefit from their billion-plus users. Amazon's Prime service brings tens of millions of shoppers to its marketplace every day, which makes its seller services more attractive to third-party merchants. Netflix tens of millions of viewers share feedback about what kind of content the company should invest in and provide the revenue to support its massive budget. The lock-in effect of the Apple ecosystem creates significant switching costs for iOS users. That advantage is getting stronger as Apple develops more services such as Apple Music and Apple Arcade. All 5 FANG companies have intangible assets that should make them more profitable than their rivals. Facebook, Amazon and Google have troves of user data that they can tap into to target advertisements. Netflix's move to original content and exclusive licenses makes its content library irreplicable. Apple is one of the few companies that makes both the hardware and the software for its devices, and it's certainly the only one doing it at its scale. These competitive advantages can make the FANG stocks great potential investments. Still, investors may want to examine each stock's valuation relative to its own historical value and that of comparable competitors before buying. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.